Hello traders, and thank you for joining me for today's webinar where we will be discussing stochastics and using that on our 60-second binary options platform. So before we get started with our new material, we're going to go ahead and do a brief review. So some of the other webinars we've had, we were using netdanya.com for our technical analysis, which I do still recommend signing up for a free account with NetDanya. But today we're going to be also using tradingview.com. I also recommend signing. You will have to sign up for an account to use this software, and it is free. It's a free account, and so this is where we're going to use our Japanese candlestick charts. Okay, so this is what we have here is a Japanese candlestick chart, which is a combination of a line chart and a bar chart, and it shows price movement over time. So along the horizontal axis, we have time, and along the vertical axis, we have price, which is separated by pips. Okay, so we are able to adjust our time scale over here. Right now I'm on a 1 minute chart. It means each of my candles represents 1 minute in time. And that's the type of chart we are going to use for our 60-second strategy today. Right now we're looking at a chart of the USD JPY, US dollar, Japanese yen. And we see that in this chart we have two different types of candlesticks. We have our greens and our reds. So let's talk about our green candle first. Let's zoom in on this particular candle right here. You can see that it has two parts, a colored part, and then above and below the colored part we have two spikes. So let's talk about the colored part first, which we would call the body. This body, since it is green, it's showing a price increase for that specified time period, meaning the bottom of the body is the opening or starting price for that time period, and the top of the body would be the last or closing price for that time period. And these spikes, which can be called wicks, shadows, or spikes, they're showing the price range for this time period. So it's saying within this 1 minute range, the price started here, okay, at the bottom of the body, and it ended here at the top of the body, but it went as high as here within that minute and as low as here, shown by the spikes. So then if we look at one of our red candles, like this one right here, we see that it's showing a price decrease over that specified time period. So that means now that the top of the body is the starting price and the bottom of the body is the closing price, and the spikes are exactly the same. This will show the lowest price for that minute, and this will show the highest price for that minute. Okay, and we have two indicators added down here. I'm going to show you how to add indicators in a moment. But first, okay, so I want to go over to the NetDanya charts real fast. And we're just going to briefly summarize support and resistance, which refer to price levels on a chart that tend to act as barriers from preventing the price of an asset from getting pushed in a certain direction. So we practiced drawing a few last time just to refresh your memory. This is one of the examples we had is so after, first of all, we have to go back in time and pretend as if we were sitting here just to see how price reacts and how these indicators are working. So what I've done here is after this long, strong downtrend, it came to a brief halt at this point and started to reverse upwards. So this became a point of interest to me, and that's where I drew my support line. Now, for those of you who want to draw a support line on NetDanya, you would come here to Lines, go to Add Lines, and click Horizontal Freehand, and it changes your mouse into a drawing tool, and now you can draw lines wherever you want. Okay, so we've drawn this one line down here. I'm just going to delete these other lines. And Just out of curiosity, I wanted to then zoom back, and I saw when I zoomed back that the price did come down to a similar area and then reverse upwards again. So this indicates to me some strength behind this support line. So now what we're doing with the support line now that it's drawn is we would go along in time as if it is the present, and now we're waiting for that price to come back down to the line where it's going to do one of two things. One, it could either bounce right off and reverse in the other direction, or it could break right through and continue in the same direction. Now we want to see the price actually touch the line, and we do see that here. So now that we see that, it's telling us that the price should reverse upwards. So in this case, we would take a call position, and we're using the rule of Quattro, meaning we take time scale, which is now up here on NetDania. We have the D selected, meaning each of these candles represents 1 day in time. So we're going to multiply that by 4. So we have 4 days, and on the chart it will be 4 candles. So if we took a call position for 4 days here, we do see that the next 4 days the price does move up. So that certainly would have been a winner for us. So let's continue. We're looking for the same thing to happen again. And here we have an example. So we could take another 4-day call here. And you do see that the price does go upwards. Let's see if there are any more examples. And okay, we do. I missed that one. So right here we have a breakthrough. Okay, just for you beginners out there, we're going to avoid the breakthroughs for now because it's telling us that the downward momentum is very strong and it could continue to push right through that support line. It does not happen to be the case in this situation, but it certainly can happen. So let's continue and see if I can show you an example of where it does happen. Okay, so at the time of our trading, this would have probably appeared to us to be a breakthrough. It would have appeared to be a solid body until the closing of the period. So I would have avoided this trade as well, and you do see the price decrease thereafter until it finally breaks through. And after that breakthrough, you see the price continue downwards, and that's exactly what I'm trying to avoid. All right, so let's quickly do a resistance example, and then I want to get to our main topic, stochastics. Okay, so our other example would be right here. So we had a nice strong uptrend that came to a brief halt, and followed by 2 periods that ended in similar areas. So I drew a line right here. Okay, so now we're doing the same thing in the other direction. Just one moment. Okay. And we're waiting for the price to actually come up and hit that line. See it come close there. All right, and now we have our first touch, and that would tell us that the price is going to reverse back downwards. See, we're on a day chart again, so we're going to take this for a put for 4 days. From this candle, it's going to be 4 more candles, and you do see 4 candles later, the price is much lower. So let's continue. And we want to see that price actually come up to the line. It's coming closer. Let's see if we get there. Okay, and we have a hit right here and a bounce. So that's a perfect example of where to take another 4-day put. And the price drops drastically after that point. So another great example for us. That might be the last one. So why don't I tell you guys a little bit about stochastics. Just one moment here. All right, so this technical indicator, it dates back to the late 1950s and has stood the test of time. Developed by George C. Lane, the stochastic oscillator is based on the observation that as price increases, closing prices tend to be closer to the upper end of the price range. In downtrends, the closing price tends to be near the lower end of the range. Stochastic oscillator is made up of 2 lines oscillating in the range of 0 to 100. The K, showing the ratio of differences between current close and lower price and between highest and lowest prices, which is the main line. And the second line, the D line, would be a moving average of K over a chosen period. So let's see if we have a picture. All right. Here we have our stochastic oscillator. So like the RSI, stochastics help us determine overbought and oversold conditions in the market. And the indicator is also made up of two lines that are similar to the MACD lines in the sense that one line is faster than the other. Also, like the RSI, the stochastics are scaled from 0 to 100. And with RSI, we were watching for two separate numbers, 30 and 70, but for the stochastics, we will be watching for 20 and 80. So let's pull up our stochastics chart and see what we can do. So now we are going to go back to trading view. So if you have two monitors, it's nice to have your stochastics on one screen, your trading view on one screen and the platform on the other, but I only have one monitor to present to you, so I'm going to do half and half. So here I have my trading view. I'm on a 1 minute chart, okay? And I've added here my stochastics. Now in order to do that, you would come over here. Sorry, one moment. Okay, I can only do it from full screen. You have indicators. Click indicators and opens up a window. You come over here and you click stochastics. All right, so it's added a second stochastics for me because I already have it there. Now don't notice the difference. The default is 14, 3, and 1, and I've changed it to 8, 3, and 3. So in order to do that, come over here to the Format button, go to Inputs, change it to 8, 3, and 3. All right, so we only need one, so I'll close one of these. And here we have our stochastic lines. And you'll see this purple area is what we would call the danger zone. So what we're trying to do is wait for both of these lines to be outside of the danger zone. Okay, so if both lines were under the danger zone, it would indicate to us that the asset is oversold and likely to reverse upwards. And if the lines were above the 80 range, then they would be telling us that the asset is overbought and likely to reverse back downwards. So the first thing we do is wait for the lines to come outside of the danger zone. And I think we're going to have that in just a moment. So I'm going to get set up over here. Now I want to use the bottom choice here just so I can keep an eye on my trades. So I'm going to select USD JPY. I'm on the 300-second, and I have my lowest trade amount ready. Now in order to do this strategy properly, for regular accounts, you're going to want to have $10,935, and for VIP accounts, $54,675. Because what we're going to be doing is taking positions on a reversal with the intentions of waiting out trend, which can take some time. So some of our trades might be going against us, in which case we need to take bigger positions in order to cover our losses. So right now, we're waiting to see these lines come out of the danger zone, and we're not going to take a trade until we see the lines cross each other like they did right here. So I think we're about to see that here with the USD JPY. Okay, so now we have both our lines outside of the danger zone, and we are waiting for the cross. And once we see that cross, we're going to take a call position. So let's just wait another minute or two, and we should be seeing that cross. And we do have many economic events happening today in the market, which does not make it the prime time to use this technical strategy, but this was when our webinar is scheduled, so we'll have to make do. So from experience, I'm seeing this in a place where I would have taken the call already, but just to teach you guys the textbook method, we are going to actually wait for the cross. And we should see that shortly, so let's just hold on. Okay, and we have our cross. You see that, ladies and gentlemen? Now we're going to take our call position. All right, and immediately I'm getting my next value ready, just in case the trend goes against me. And what we're going to be doing, we're going to be waiting for the pips here, the current price, to be at least 5 pips lower than the last strike rate. That way, the next trade I take will be at a much better rate. And with a higher price, it is more likely to give me a good outcome. It's also good to bear in mind that we have 5 minutes here, so we don't want to go too fast. So even though we are 5 pips different, well, we're 10 pips different right now, 16, so I'm going to go ahead and take that second trade. And immediately get my next value ready. Well, this is what I'm talking about. You really want to stay away from these trading during these economic events. We do seem to have some fundamental information working against us, but anyway, we're definitely in a good zone to take a third trade. And the whole concept of this is even if these 2 trades lose, the payout from the last trade will more than cover the losses and still give me a nice little reward. So we have our 4th value ready. And now we wait. We're waiting. If this stays green, it does not require further action. If it turns red, then we're going to wait until we're 5 pips lower than our strike price and then take another trade, which we might have to do. So, one thing that you can run into trouble with is if you take the trades too early. And we did move very fast here just because we do have time constraints. But let's wait a little now. Time is precious. We seem to be having a fight between buyers and sellers right here. This could be our turning point. But let's not jump to conclusions here. We have time. Let's wait it out. And while we're waiting, we can go ahead and keep track of our trades. So far, we've made a $5 trade, a $10 trade, and a $30 trade with no trades having expired yet. So now we're going to wait. And this belly, it's forming nicely here. Hopefully the price will go along with what the stochastics are telling me here. It's telling me that they're about to curve back upwards. So as long as we have our last trade in the money, then we are fully in the green, even if these 2 trades lose. It would be nice to win all 3, but let's see what happens. We took our first trade all the way up here, so I'm not really expecting to win that one. Our second trade right here. It's possible that we win this second trade. For the third trade, it's looking pretty good for us. We're almost 30 pips in the money. So let's just continue to wait here. As long as the price stays where it is, I'm happy. I'm happy to win the last and biggest trade. Don't necessarily go into this expecting to win all the trades. That is the whole concept of this method, is to cover the potential losses and to start small. And look at that, our second trade is turning green. I'm not sure we're going to hold on to that gain, but let's see, we've got time here, and it looks like our first trade is going to end in a loss, our $5 trade. So we're going to pencil that in over here once it's confirmed. It's a confirmed loss. So return amount 0. Okay, so let's continue to wait here. Another minute. It doesn't look like we're going to win the second trade either. And we do see the price coming back down, so we might have to be on the watch. We already have our next trade lined up, and this one's going to lose for us as well. Always want to be sure you have to watch while it validates, and it is a loss. So let's just wait for another 20 seconds, and hopefully we should end our whole session in the green. All right, $51.60. Let's just make sure it won. $51.60 here. So if we type that in, well, my keyboard's not working. Just 1 second, everyone. Okay, it appears that my keyboard has died. Oh, we got it back. Hold on. Okay, so all in all, we are up $6.60, and that's because we are trading with such small amounts, remember, but we did cover ourselves nicely. Now let's move on and look for our next opportunity. Okay, so we have a couple assets to choose from here. So let's cycle through and see if we can find the right choice. Okay, and here we have it, AUD USD. We have it crossed. Let's hurry and take that position on the 300-second chart. We're moving now. Okay, so my account is now switched to VIP. So the 25 trade will be the same as a $5 trade for you folks at home, and we're going to take a call position. Hit approve. Immediately lining up the next trade. For VIPs it's 50, for regulars it's 10, and we are waiting for at least 5 pips. So while I'm waiting there, I'm gonna just remember our first win of $6.60 here and erase all this. Okay, so we might not even. So we're just moving right around our strike price, right on it, tied at this point. Okay, so we're now 5 pips different. Let's go ahead and take that next trade. Immediately I get my next trade ready. 50 over here. Something wrong. Keyboard. It's a wireless keyboard running out of batteries. So let's see if it works until the end of the session at least. So we have our third value ready. Our second trade is still in the green. Red, our first trade not so much. And we're still going to watch to see if we go down, and we might have to catch a trade, a third trade that is 5 pips lower than this trade as well. Okay, we had a big drop now, so now we're probably going to want to catch third position. All right. We have a much better strike point here. And the price might continue to drop, but we'll see. So let's just write in our third amount. And another big drop. But, you know what? Well, it's such a big drop that even though I do recommend waiting, I do want to catch this strike price right here. So, okay, so now we'll move on to the next. And once again, you do want to stay away from the strategy during the time of economic events. This is when our webinar is scheduled, so we have no choice but to do it at this time, and it might very well be working against us at this point. But let's continue and see what happens, because we may have a reversal. We do see the price moving in our favor right now, but, you know, I would like to see it move much higher, but as long as our, okay, so our last trade is tied now, so we do have to be on watch here. We might have to be ready for that next trade. We're only 2 pips lower, so I wouldn't necessarily recommend taking that next trade yet. And I do see an opportunity to grab a great strike price. So okay, I'm going to take that next trade. Oh, that was a no-no. The price jumped right back up as we took that last trade. We certainly have to wait now. And we do have our first 2 trades expiring as a loss. We're still waiting for the price to turn around here. So as long as our last and biggest trade is a green, we know that all losses that can happen from the other trades will be covered. But we're definitely not in the clear yet. And this type of situation is exactly why you need to have enough money in your account to cover the impending losses. So our first 3 trades will expire out of the money. We're just really wanting to bank on that last trade, which hopefully does not go against us. All right, so I'm now going to take that next position. So we have our trade still green, the top trade, and it's possible that we win both of these trades, which would be nice. Just over a minute to go with this second to last trade. And just one moment, please. Yo, doing a webinar. So we're looking a little better now. We have 10 more seconds for this trade, and it could expire in the money for us. We'll just confirm that win for 23.76. And it won. Okay, so and let's wait for our last trade, which we still have just over 2 minutes. And after this one ends, we'll do a quick Q&A and probably end the session there. So our strike rate is right here. As long as we stay above this dotted line, we will see a victory. Still, our next value is queued up, just in case. Okay, so we might have to take this trade. This last trade could come down to the wire. This is our level that we're watching for, where the dotted line is. And just over half a minute to go. 5 more seconds. Let's just confirm that we win this 71.28. One. Okay. 71.28. So for our second session, this is our total winnings, $3,429. We used a total of just over 6,000 to trade, and our returns were 9,500. So with the $6 from before, just over $3,430 using our stochastic strategy on this 300-second chart. So at this point, we don't have time to get into any new material, so I do want to leave you with my email address just for those of you who are not going to stick around for our Q&A. But right now we do have a couple minutes for those of you who want to write some questions. Just one moment here. And so will it be easier with more indicators? It's not necessarily easier with more indicators because different indicators can tell you different things, but it can make your indication more accurate. Say if you were to combine the stochastics with RSI, you would get less, you would see less trading opportunities, but they could very well be more accurate. So those of you who are signing out now, I want to thank you for joining us for today's webinar on Stochastics 60-second strategy. We do have another webinar next week. We'll be talking about the choppiness index. Everyone who attended here today will be getting an email with a registration link within the next 1 or 2 days. And it was a pleasure being with all of you today. I do have, if any of you have 1 or 2 more questions, happy to answer it. Anyone who has questions about the actual format of the stochastics, please write it to me in an email, and I can answer you there. We're using the 833 because it has the best outcome percentage with our 300-second strategy. The math formulates well with 300 seconds and counting 8 periods instead of the 14. Okay, no one appears to be writing any questions, so once again, thank you all for joining us today. That's going to be it for our webinar. And for those of you who are interested in a one-on-one session with myself, please feel free to contact an account manager. If you're unable to get a hold of an account manager, you can send a request to my email, and I will put you in touch with the right people. So thanks, everyone. Have a great day. Thanks for joining me. Bye.